the TCFD is a private sector initiative, but it was formed by the FSB, the Financial Stability Board, which of course are the financial regulators from G20. And so those financial regulators chose representation from their jurisdictions to serve on the TCFD. And then the FSB Secretariat mixed it up to make sure that we had the right balance between preparers and users from a wide range of jurisdictions from the G20, but also different skill sets. So we have CFOs, CIOs, sustainability heads, accountants. It's really a wide range of people. Anyone who might be touched by the sustainability bug, as it were. And so it's a really good group. We also have a number of experts from the Big Four as well. And, this was created in order to do two primary things. One is to inform better capital lending and allocation, investment and underwriting decision-making, but also to create an ecosystem of information that would help create more visibility for those regulators to see if and where there are concentrations of climate-related risks within the financial system. And so a tall order, but I think the FSB did a great job in handing us our remit. And so we were launched at Paris in 2015. And we had about 18 months to come up with recommendations. Mark Carney is not known for his patience. And so, we did about every 6 weeks, we would meet for several days in a closed room. And that really helped build relationships and trust. And let's just be clear that these were hard fought recommendations. They were not easily agreed upon. And I think we found the right balance. And the balance is the key, right? The balance is this: what's the burden on the preparer versus what are the needs of the users to really make more informed capital allocation decisions. And you'll note that the recommendations, I think this is a very important point. This was not a bunch of people getting in a room and reinventing the wheel. There had been a tremendous amount of work done, both by regulators, especially in the EU, and voluntary standard setters. So we had a great foundation to start. I think the key sort of thing that the TCFD did that made it sort of more accessible to the mainstream audience, because for those of us on the phone or on the line here who've been working on this stuff for 20 years or more, we were quite a small band of people. I think we can now all say, and I'll get to this in a moment, that the TCFD and climate-related risk and opportunity disclosure is well understood by boards, senior management of firms, as well as policymakers and others. It was not. You have to remember this in 2015. I think the key to TCFD success was two things. One, it really tried to take all the good work that had been done out there and focus it on financial related risks and opportunities. And so in the past, in general, and I'm generalizing here, most disclosure was aimed at sort of how does a company impact climate, right? And this really focused in on saying, how does climate impact potential financial performance of both non-financial actors and financial actors? And that's not to say that the other part is good. And my colleagues from the EU, which I totally agree with, it's very important to have a total look. But it was also just as important at that time to try and hone in on the financial aspect of it, because that, and this was why Bloomberg, I think, got so excited about it, it kind of depoliticized the event. I live in the US, and as you all know, the US has highly politicized climate. We are not where Europe is, where there's general agreement across sort of party our ideology that this is a problem that everyone needs to solve. We're not there in the US, and we're not there in a number of other jurisdictions. And so for us, we found that if we could focus on that, that would help depoliticize that and help bring it into the financial system writ large. So I think we were successful in that. The other two reasons really that we were successful, in my view, is the way in which the TCFD was written. It was written not by climate people, but by a group of people who had worked in policy and had worked in the private sector and tried very, very hard to make that language of finance. I used to have a joke in the sustainability world. My colleagues would say, well, we need to teach the financial community how to speak sustainability. And I would quip back that it's that old Bob Dylan line, you know the golden rule, he with the gold rules. And what we as sustainability professionals really need to do is speak the language of finance to help integrate this stuff into the system. And so, and let's not forget that having the FSB moniker as part, that this is an initiative, although private sector led, for the market, by the market, and voluntary, it's your regulators asking you to do it. And I jokingly call that voluntold. And so I think those three things were kind of critical to getting the traction where we are today. And Stephen, I can talk about that if you'd like, unless you'd like to move on.
No, if I may, Curtis, because this is fascinating, the insight to where it came from. And as you said, that Bob Dylan line, and I remember from talking to you before, it wasn't just the climate experts in the room. Obviously, they were there, but it was those regulators and others that really put, as you said, a lot of effort into developing this. So please, the traction, actually, I can see questions coming in actually for you already. And one of them is actually around that traction point. Like, what has happened since Paris in 2015 in the near 6 years as you build towards COP this year on TCFD, please?
Yeah, I mean, and Tom and Sarah, who I worked with a lot on in the early days of the tag, and I'm really glad to see both of you again joining this group. No, we've all worked on a number of initiatives over the years. I've never worked on anything that's had this kind of traction. And I think it's partially due to all the things I just said, but also partially to an idea whose time has come, if you will. I really didn't know that it would be this successful. And what does success look like? Success looks like this being on the agenda of boards and senior management, as I mentioned, but it means it's within the vernacular now. And working with Mark Carney and Mary Shapiro over these years, we spend a lot of time talking to CEOs. I am wildly impressed with the level of understanding that some mainstream CEOs from huge institutions who have, as we all can imagine, a lot on their plate to run their businesses, are semi-fluent these days in climate and climate finance, which is really just remarkable. But what success looks like in numbers is that we now have something like 2,300 organizations who are supporters of the TCFD, over 100 regulators from a broad range of jurisdictions, and several countries, including Ireland and many others, who have come out in support of the TCFD. And I think it's important to note that the TCFD is intended to be a sort of foundation for further work. This is not, and while we had a lot of good, smart people, and we developed a framework that we think is very accessible, scalable, it's intended to be durable also. And you'll note, and some people complain about this, which I completely understand, is it's very principles-based. A lot of it's qualitative. It's intended to sort of set the table, if you will, for further work. The TCFD are not sector specialists. They are also not standard setters. And so our hope was to kind of create a framework around governance, strategy, risk, metrics, and targets that is well understood by the business and financial communities, because that's how people run their businesses in general. And so it was important to not create a sort of totally separate thing that needed to be managed separately, but rather was considered the way they consider everything else and integrated into their sort of governance, strategy, risk, and metrics and targets, and make that consumable. Now, I think there's, and we're very proud of all of that. And as you know, there's been a lot of good work done since then. And I had the pleasure, as I noted earlier, working with Tom and Sarah on the tag and using, TCFD foundational considerations in the further development of the non-financial reporting directive, which is now something different, which is named, I can't remember, sustainability reporting directive. So it's intended to be foundational. IFRS is using TCFD to further their work. You know, the SEC has put out obviously a consultation on this, and there's reference to TCFD. We're not the answer. We are a foundation on which to build, and I think that's really important point to make.
And Terence, sorry, Curtis, if I could just jump in on that point, because that is an important point, that the foundations, but we are, and we'll talk to Tom about this in a moment, we are seeing TCFD, as you said, being brought in to a lot of these big initiatives, SEC, that consultation, IFRS. So that must be absolutely a fantastic point to see, and as an output of your work. And so that firms are sign up as a supporter of TCFD now. It's not just, as you said, it's not in isolation. It's fed into so many different policy and regulatory initiatives. So at a minimum, as a firm, you should be a TCFD supporter, and you should be looking to report against this framework. Would that be a good point?
Yeah, I mean, look, let's be candid. When a regulatory body like the FSB starts a voluntary initiative, I think it's clear what they're doing is signaling to the market that this is coming. And you know, in the old days, we used to talk about if sustainability and climate disclosure would be regulated one day. And now it's just a question of sort of how and when, specifically in different jurisdictions and in what way. So, you know, for those TCFD supporters and folks who have been reporting against TCFD over the last several years, congratulations. You have now had a lot of practice and an opportunity to iterate. And frankly, the feedback that we've been getting from the participants in the TCFD process, not just the members themselves, but the companies are actually using them, using those to prepare their disclosures, as well as the financial market participants who have given us feedback on what's been useful, what needs greater clarity. And if you go to the TCFD website, you'll see there's a number of reports that have been produced. And in fact, we have a consultation open right now, closes July 7th, so semi-soon, on potential improvements to the implementing guidelines around metrics, targets, and we've added transition planning given where the world is headed. And it's really important that we get feedback from the market on that consultation on our proposed enhancements. Yes, I am, Stephen, to answer your question directly, I'm extremely proud of what's happened and how things are moving. And of course, the TCFD, I joke, the FSB said this would be an 18-month project. We're now on year 6. And I think we're sticking around in order to collaborate. What I'm happy to see is, you know, part of the TCFD's role was to sort of help with the fragmentation that was out there. A lot of companies were confused around this. And I'm proud that a number of the voluntary groups like CDP and SASB and GRI and IIRC and CDSB, those voluntary disclosure frameworks, which we built the TCFD on, have also taken back some of the TCFD refinements and integrated into their disclosure frameworks as well. And so very proud of that. We are working very closely with IFRS, with the EU, with the UK, with all the regulators, with the group of 5, those groups that I just talked about, IOSCO. I think the key here, in my view, is while there will be jurisdictional differences, as there should be, these economies are different, we hope that there's at least a foundation that's global, and because financial markets are global, and we need some consistency and some comparability as a foundation. So we hope that the TCFD provides that. And I'll point out, Stephen, as I'm sure many of the folks in the room know, the G7 communique that came out recently did signal that those G7 economies plan to take on a path to mandatory on climate-related risk and opportunities using the TCFD as a foundation. And obviously, I'm feeling quite happy about that outcome.
Look, that's great. And I was going to come to that because it was a significant outcome. And it was great, actually, the Irish Minister of Finance, Pascal Donoghue, who was also the president of the Eurogroup, was actually present at that meeting with Janet Yellen and everybody else. So it was great that the Irish Minister was in the room and obviously, you know, in his Europe role, inputting. But I thought, what a fantastic achievement. And look, Curtis, just before we get into Tom, I have one more question, then I'll obviously come back. But, you know, TCFD, we're looking at the finance hub out of COP, the four key themes, if I can just recap them: mobilization of capital, risk management, returns, and reporting. So TCFD is built into the reporting piece. But given your role in terms of COP and your advisory role, how, as we prepare for either an in-person, a virtual, a hybrid COP, how is the preparation around green and sustainable finance going? Can you give us any insights? I know there's a lot of noise, but I suppose if you look at that G7 point a few weeks ago, voluntary to mandatory, where do you feel the sustainable finance agenda overall is right now, please, Curtis?
Well, I think the good news is that the finance sector is really stepping up. I mean, there's always more work to be done, but I just got off a call before this with what's called GFANZ, which is the Glasgow Financial Alliance for Net Zero, which is trying to bring together all these different financial sector net zero alliances. So the Net Zero Asset Owner Alliance, Net Zero Asset Manager Initiative, the newly formed Net Zero Banking Alliance, and the soon to be formed Net Zero Insurance Alliance. And they're also talking about creating alliances for what we call financial market intermediaries. So stock exchanges, credit rating agencies, index providers, investment advisors, consultants, et cetera. You know, what Mark will say is that this is about every single financial decision taking climate into account. I mean, that's the goal, right? And more than that, having the financial sector play a very strong and leading role in helping the real economy to decarbonize. I want to make a point. We don't want divestment. What we want is investment. We need a whole economy transition. And in order for that to happen, it's going to take a lot of money. And it's our view that financial institutions are best positioned to work with their clients to invest in that transition. That's the key. We need a whole economy. You're as strong as your weakest link. And so that's the goal. From that perspective, the four pillars you mentioned, reporting risk, returns, and mobilization, there are key anchor initiatives under each of those. Under the reporting one, it's the path to mandatory for TCFD-like reporting. Under the risk one, it's about NGFS, scenarios, climate stress testing of financial institutions. On the return section, it's about this coalition GFANZ, transition planning at the financial sector level and how they work with their clients. And then, of course, measuring progress against that. So portfolio alignment tools, et cetera. And on mobilization, you know, we're doing a lot of work on the voluntary carbon markets, which I know is very controversial, but it's got to be sorted out. You know, if every company in the world were to go to net zero, even without offsets, we would overshoot our carbon budget. And so I do think there is a specific important role for carbon credits, particularly the co-benefits associated with it, in catalyzing investment and ultimately in removal technologies, in financial flows towards emerging economies. That's going to be very important, the mobilization piece, because again, you know, the emerging economies are most vulnerable for this. This is really important that they get the financing they need. So I'm encouraged by the financial sector's leadership. You know, obviously you're as strong as your weakest link. So we need policy support for that. You know, they can't do it alone. You know, in the US, for example, it'll be very hard for a financial institution to green its portfolio if we don't green the grid and move towards electrification, for example. Like, they're dependent on that. So it's going to be really important to have the right policy support. And of course, the real economy has to invest as well. So I'm encouraged by that. In a weird way, I probably shouldn't say this. It's good that COP was delayed by a year because it gave us an opportunity to really build momentum.
Okay, thank you very much, Dr. Curtis. I know you're going to stay with us, and it's interesting actually building on your alliances around net zero, investment, insurance, banking. I can let you know that I'm just off a call with my co-chairs of the UN convened Financial Centers for Sustainability, and so over the summer we're now working on a statement. You know, could the financial centers, which is nearly 40 globally, come out and support the net zero agenda as well in time for COP. So it is really about that ecosystem, as you said. And, you know, if I can then move on and just build on your point, because I think a key thing you said there is also policy support. And I think it is incredible. I know you remember the EU Technical Expert Group, what the EU has done over the last few years in taking a leadership on the sustainable finance agenda.